Credit has the ability to build a modern economy, but lack of credit has the ability to destroy it, swiftly and absolutely. Ben Bernanke, too big to fail. These words capture the double-edged nature of credit. It powers growth, investment, and innovation. Yet when mismanaged, it can topple entire economies. But what does that actually mean in practice? How can something as seemingly simple as borrowing money lead to both prosperity and collapse? Today, we're going to unpack the mechanics of credit, its cycles, and the hidden risks that lurk in every boom. Credit, at its simplest, is borrowing today to spend or invest. Businesses borrow to grow, individuals take out mortgages to purchase homes, and governments issue debt to finance social programs or infrastructure. Economies can expand more quickly thanks to credit than they could if everyone only spent their earnings. Consider credit to be the lifeblood of an economy, allowing for growth and survival. However, credit, when misused, can hasten economic devastation, much like oxygen can fuel a fire. Irving Fisher, American economist and statistician, writing after the Great Depression, described the dangers of over-indebtedness in what he called the debt deflation spiral. Imagine this. Borrowers take on too much debt. A shock hits perhaps a sudden drop in asset prices, and they are forced to sell assets to repay loans. As they sell, prices fall further, making debts even harder to repay. This forces more selling, driving prices lower still, spreading the crisis across the entire financial system. Fisher argued that debt doesn't just slow growth, it can destroy economies swiftly. History provides vivid examples. In 1929, speculative borrowing fueled a stock market bubble. When prices crashed, margin calls and forced sales caused a chain reaction, collapsing the financial system. Almost 80 years later, the U.S. housing market demonstrated the same pattern. In the early 2000s, borrowers assumed home prices would continue rising indefinitely. Banks lent with minimal scrutiny, and financial products became increasingly complex. When the bubble burst in 2008, credit froze, global markets tumbled, and the world witnessed a crisis of unprecedented scale. Ray Dalio, an American hedge fund manager and writer, expanded this idea through his concept of the long-term debt cycle. He distinguishes between short cycles, which occur roughly every 7 to 10 years as credit expands and contracts, and long cycles, which span decades and result in massive deleveraging. In long cycles, debt accumulates to the point where interest payments consume a growing portion of income, leaving economies fragile and vulnerable to shocks. Historical examples include both the Great Depression and the 2008 crisis. Dalio links debt cycles to seasons. Short winters happen often, but once in a while, a long ice age reshapes the entire landscape. Modern economists and regulators closely monitor credit booms and busts. When banks lend too freely, asset bubbles form. Investors assume prices will keep rising, leverage increases, and risk-taking accelerates. Eventually, the system reaches a tipping point. Consider the Asian financial crisis of 1997, where excessive foreign borrowing and currency mismatches caused sharp collapses across multiple economies. Or the Eurozone debt crisis of the 2010s, where sovereign debt issues and banking fragility led to years of stagnation in affected countries. These examples demonstrate that even well-regulated economies remain vulnerable to credit imbalances. Credit cycles reflect real-world events and are not merely theoretical ideas. Consider a family that takes out a loan to fund their education or purchase a car. Debt can be controlled if income increases consistently. However, the same debt becomes a significant burden if circumstances change, such as a job loss, unexpected medical bills, or market shocks. The same ideas hold true at the national level. Credit increases risk and growth. An economy can grow more quickly and fall more violently the more it depends on borrowing. The paradox of credit is that it is both the engine and the vulnerability of modern economies. It enables progress, innovation, and opportunity, yet it carries inherent fragility. Overconfidence, excessive leverage, and speculative behavior can transform credit from a tool of growth into a mechanism of collapse. History teaches us a universal lesson echoed in a timeless proverb. Hard times create strong men create good times create weak men. and weak men create hard times. Financial crises, like human cycles, force discipline, caution, and resilience. They remind us that prosperity is temporary, stability is fragile, and vigilance is essential. Even today, global debt levels are at historic highs. Households, corporations, and governments are all heavily leveraged. By modifying interest rates and enacting regulatory measures to stop bubbles, central banks attempt to carefully manage credit. However, history indicates that no system, no matter how advanced, is impervious. Knowing how credit flows, grows, and contracts can help us foresee possible crises before they happen. Ultimately, credit is neither hero nor villain. It is power. Power to build economies, create opportunity, and lift societies, but also power to destroy, destabilize, and impoverish. Recognizing the rhythms of debt, the patterns of expansion and contraction, and the historical lessons embedded in each cycle is key to navigating the financial world safely. It is a lesson not only for economists and policymakers, but for anyone seeking to understand the forces shaping our world today.